All right, if you've had your eyes on the crypto markets lately, you've seen the absolute bloodbath. But was that just chaos, or was it something else entirely? In this explainer, we're going to break down what it really means when a market purges, and, let's be real, the most important part, how you can actually survive it.
I mean, it happens so fast. In just a blank, Bitcoin's price went into an absolute freefall. We're talking a drop of nearly $15,000 from its value. For anyone holding on, it was just brutal. That stomach-churning feeling like the floor just dropped out from under you.
And what happens when the price drops that fast? You get forced selling, a tidal wave of it. Over $2 billion in derivative positions got liquidated. Now, this isn't just a bunch of people panic selling. No. This is automated, forced selling that basically pours gasoline on the fire, creating this insane cascade that just pushes the price down even further and faster.
So, yeah, that brings us to the big question here. Was what we saw just a random, senseless massacre of everyone's portfolios, or was it a necessary, maybe even predictable rebalancing of the whole system?
Well, to answer that, we've got to kind of reframe how we think about the market itself. See, the market isn't angry at you, it doesn't have feelings, it's just a system, right? And like any system, its one and only goal is to find balance.
And to really get this, we have to talk about liquidity. Think of it like the market's lifeblood. When everybody gets way too bullish, they all leverage up on the same side of a trade, liquidity gets dangerously lopsided. So that crash, it wasn't personal. It was just the system's brutal but totally necessary way of finding its balance again.
Okay, so the market itself isn't emotional. Fine. But the people in it? Oh yeah, they definitely are. And during a downturn, most investors follow this very predictable and often, let's face it, self-destructive psychological roller coaster.
And this right here, this lays out that path perfectly. First, you get the shock and panic, total chaos. But then comes the really dangerous part, stage 2, hope. This is the trap. People start hoping for a quick V-shaped recovery, right? It'll bounce right back. When that doesn't happen, they slide into stage 3, pure exhaustion and surrender. And that's usually when they sell, right at the absolute bottom. See, most retail investors don't lose because the market fell. They lose because they got trapped in these two stages without any kind of plan.
And that brings us to maybe the most crucial point of all. In finance, hope is not a strategy. Risk management is. You just can't wish your way out of a downturn. Success in these markets, it doesn't come from hope, it comes from having a solid risk management plan before the storm even rolls in.
Okay, so we've got the mechanics down, and we understand the psychology. But why did this happen on such a massive scale right now? To get that, we need to zoom way out from the charts and look at the big picture, the macroeconomic forces that are really pulling the strings.
And it really boils down to 3 major forces that were screaming at big money to de-risk. You've got higher interest rates making safe stuff look good again, a huge reevaluation of those high-flying AI and tech stocks, and just general geopolitical instability. When the big money decides to de-risk, guess what's often first on the chopping block? Yep, assets like crypto. Let's dig into why that is.
Really, it's just a simple story of a great capital migration. Think about it. When interest rates are high, why would you take a massive risk in crypto when you can get a pretty decent and totally safe return from cash or bonds? At the exact same time, the tech and AI sectors were getting a reality check after that huge run-up. And since crypto is super correlated with tech, when tech sells off, crypto sells off right alongside it. This isn't some grand conspiracy, you guys. It's just the logical flow of money, always searching for the best risk-adjusted return it can find.
And yeah, that absolutely includes the big institutions. We're talking about firms like BlackRock and Fidelity. They aren't your enemy here. They're not trying to crush the little guy. They are just managing trillions of dollars, and their entire job is to rebalance their giant portfolios based on changing economic winds. Understanding their playbook is way more useful than just treating them like the boogeyman.
All right, so the market purged itself. Capital has moved out. So, what happens next? Well, this is where we have to tackle the most dangerous myth of all, the myth of a quick, painless recovery. I mean, we all hope for that clean, sharp, V-shaped bounce, right? The one that makes everyone feel like a genius again. But the reality? Oh man, the reality is almost always a slow, painful, choppy grind upwards. It's a process designed to frustrate everybody, the buyers, the sellers, while the system flushes out all that excess leverage. It has to shake out all the impatient investors before a real, sustainable trend can even begin.
So, what's the key takeaway here? It's the trying to rush things, trying to force a return to all-time highs. That's a losing game. The market does not reward haste.
It rewards disciplined patience. And that brings us to the final and honestly the most important section. Instead of just reacting to whatever the market throws at you, how do you take back control? This is your survival manual. Think of it as a checklist to see if you're actually prepared for this stuff.
All right, first question, and I want you to be really honest with yourself here. Do you have a clear risk management strategy? I mean, a written down plan. Do you know exactly where you're going to cut a losing position or where you'll take profits before you even click the buy button? Okay, number 2, leverage. We got to talk about it. Yeah, it magnifies your gains, but it magnifies your losses even more. So are you using so much leverage that one bad trade, one of those liquidation cascades like we just saw, could completely wipe you out?
Number 3, and this one is so crucial, do you have cash reserves set aside? Because having cash isn't just a defensive move, it's an offensive one. It gives you the power to survive a downturn without being forced to sell at the worst possible time, and it gives you the ammunition to buy when there's blood in the streets.
All right, number 4, have you actually war-gamed the worst-case scenario? It's easy to be a bull when everything's green, but what is your exact plan if the market drops another 30, 40, or even 50% from right here, right now? If you don't have an answer to that question, you don't really have a plan.
And finally, the ultimate gut check question. Why are you in this asset? Are you investing based on a deep, fundamental understanding of its value and its long-term potential? Or are you just chasing the price because of FOMO, the fear of missing out?
Because here is the harsh, honest-to-God truth. If you can't answer those questions, if you don't get the cycles, the flow of capital, and your own psychology, then you're not really playing the game. You're just becoming the exit liquidity for the people who are.
And that brings us to our final thought. Look, in these wild, volatile markets, the goal isn't just to get rich quick. The most important goal is just to stay in the game. Because in finance, surviving to play another day, that isn't just step 1. It's the greatest victory of all.